Hi, I'm Mandi Feely-Swain, and this is another episode of Origination Boost podcast. My guest today is Mr. David Dysert. He is a secondary marketing director, chief man in charge of the lock desk, all things rate at Premier Mortgage Resources. And I'm always incredibly grateful to have his knowledge here at Premier because he delivers information about mortgage rates in a manner of which we can understand it and share that information with our clients. So, David, why don't you give a little back history of like how you got in this business, first of all, because I don't think I've ever asked you that. And, you know, what is your favorite part about managing that? Because I see your screens and I come in, his office is like all of these like crazy monitors, and he's watching the market and he's watching all these crazy lines on his screens all the time. And there must have been a method to the madness of how you found this path and journey in your career.
Well, hello, Mandy, and everybody. Yeah, well, it's funny. I talk to a lot of people in this business, even people very successful folks in this business, and it always seems like it's a kind of an accidental way, into the business. So I was at an NBA basketball game, and I was just back from Europe after graduating, and I was thinking about graduate school, and a friend of a friend came over who was a loan officer, managed a small branch, and said, "Hey, I need some help. I know it's not what you want to do probably long term, but I was actually answering phones."
Sounds like my life. That's how I got in the business too. Yep.
Yeah, yeah. And apparently, I didn't give good phone, as they say, and they kindly asked me to do something else. So I got an opportunity to work for a wholesaler. Um, they had me start doing automated underwriting. This is, I don't want to admit my age here, but this is back when automated underwriting was brand new. And actually went back to Virginia and DC to Freddie Mac and learned LP and DU. And then I ended up managing a team of folks, um, junior underwriters who were doing pre-approvals. Again, showing my age, we were faxing the pre-approvals back with the US findings. And then we broke away and formed a wholesaler, just a group of us, and we needed somebody to do secondary. And I learned the business then, and with some help, and I've been doing it now for 30 years. So
Yeah, and the beautiful part is David's still learning as we go. You know, Premier Mortgage, when we started, we didn't have all our agency tickets, and then we didn't have, and it took us a while to have our Ginny Mae ticket, and that is a whole nother kit and caboodle that you end up having. And as our company has grown, David's grown with us, and so we've learned a lot of like, great things together, and he manages that desk so well and the evolving market. And here we are, right? We're in a week that is kind of wild. I mean, we're getting mixed bag signals from the market. Like you've got a lot of political things happening, and you think the Fed chair is in charge, but then here we swoop in and the Treasury's talking. So let's talk about just what is happening this week. It's kind of wild.
sure. Well, last week we did get that announcement from Scott Bessent, that's our Treasury Secretary, that they were going to do basically what amounts to a twist. It's not a new idea. It's basically taking the proceeds of shorter term bond auctions and reinvesting those in the longer term. Again, just a little quick summary of what that means. The longer term end of it. So the Treasury yield curve, we've got, the government issues debts in different different amounts. So there's short end of the term all the way down to, months, and then all the way up to 30 years. They've actually floated the idea of a 50-year bond, but that didn't come to fruition. But the 10-year and the 30-year bond, those really are the 10-year bond, really, the 10-year Treasury really is what the mortgage rates are pegged to. So the federally has control over that short end of the curve, the short term, but the longer end of the term, those are investors, and that's where folks investing long term in our debt, that's what's going to drive mortgage rates. And so we really are concerned about that long end of the Treasury yield curve. And so that's when we talk about the long end, that's what we're talking about. That's what's really going to influence mortgage rates. And so we our country and our housing market really rely on the fact that the world views us as the safest a place to put their money, in the U.S. Treasury market as the ultimate safest place of all safe places. So we've benefited greatly from that. We take that for granted, and it has a direct impact on the liquidity and the availability of mortgages and the cost of mortgages. So anything that has to do with the long end, the 10-year, or longer on the Treasury yield curve, we're going to pay really close attention to. And so that's what Bessent announced was that they're seeing that that's a challenge right now because the folks that are buying the long end of the curve are concerned. One, our debt to GDP ratio is now we just the same time that Besson announced that, I think the same day we got the announcement that our debt reached $40 trillion. And this is not unique to us. All the industrialized economies, all the major central banks economies are dealing with this, very high to debt to GDP ratios based on historical standard. Japan is the highest, and they've had all kinds of challenges. And so we've been focusing on Japan as well because they are a huge buyer of our debt. And if they need to start buying more of their own debt, um, that's gonna put pressure on our bond market. So
If less buyer, that means we would have less buyers of our debt, our notes and our bonds. And so as a result of that, you know, the supply and demand right there, that does impact rates. That's a very simple concept, right? So we just touch on that, like the supply demand, why if Japan has to buy their own debt back, why that negatively impacts us.
Well, if they're so Japan has kept rates, they were in actually a negative rate stance for quite a while, and they're finally coming out of that. And so their rates are rising as they need to deal with inflation and their currency, and because they're an export economy, but they're having to deal with the fact they need to start raising rates. And we'll talk about, why a lot of people think we need to actually raise rates as well. But if their yield becomes more attractive, then you're going to have more money go into domestic and Japanese bonds. That's less money that can go into U.S. bonds. So supply and demand. Just think about that. When there's less houses to buy, prices go up. Same thing with bonds. So we're really, really, really focused on anything that's going to erode the demand for our debt, and specifically our longer term debt. And that's really what this announcement from Besant was last week. Was we're seeing some erosion in that demand. And also the administration has been very concerned about getting rates lower. It is a election year, but that's been a consistent theme from the administration, certainly to try to pressure the Fed to lower rates. Now, again, the Fed doesn't control mortgage rates, right? They control the more closely to the short end of the curve. So but now they're doing something where, well, the Fed has not played ball with them, right? The Fed hasn't lowered rates recently. And I think the president is frustrated with that. And so Besson announced this a new program to increase the buybacks. They've already been doing this about 2 billion, but now doubled that, and then since then, subsequently has said, well, we could just start using our Treasury slush fund that we have that he's pushed up to close to $1 trillion from about 650 during the Biden administration to actually outright buy bonds. So full on quantitative easing. Um, and that is
So like David, so let's go back in time a little bit, right? Because quantitative easing is what kept rates lower. And then in mid 22, they did the taper tantrum, right? I talk about that a lot, right? We talked about it a ton at Premier, but they basically, the government tapered off how much they were buying, which in as a result, interest rates went up. So they're not calling it quantitative easing, but in a way, it's putting more money in the market to buy those long-term bonds, which they're concerned if Japan is not buying our long-term bonds, that we are gonna have to buy our own for simplifying that. And as a result, in theory, mortgage rates should be better.
Yeah, anything that's going to increase, and that's a great description. Anything that's going to increase the demand for uh, longer term bonds is going to be helpful for mortgage. Now, mortgages trade in a spread to the 10-year, so mortgages in effect could widen out. Now, what's helped us in the last year or two is that we've tightened a little closer to his. So even though the Treasury yield is higher, mortgages have traded closer, in a tighter spread. So there's a relatively, but a relativity there thing going to happen. But the overall point is that anything that's going to increase demand for the longer end of the yield curve is going to be beneficial to us. And that's what the whole point of this announcement was to say, hey, we are going to support the long end of the curve. Now you'll note we didn't talk about it a lot, but what happened before that, a week or two before that, is the U.S. did a pretty substantial intervention to intervene in the Japanese currency. They sold euros and bought yen. And I don't want to get all of the complexities of currencies, but these are indicators. You don't have to understand all the dynamics of currencies and FX and all that. But the point is seeing these are sort of kind of dramatic, or they're telltale signs that folks at Treasury and other places are getting concerned about this picture, this bond picture. And so, you know, is this just a political thing? No, I think it's more than that, but it's really more of a symptom in this sense. And there is a political element, obviously, to Bessent's announcement. It begins September 9th, so it hasn't started yet. Is it really going to help us? We'll see. There's been some significant criticism of the buyback announcement, and I'll get into that in a minute. But what it's really suggesting is they're seeing some real stress at the long end of the curve, and they're needing to take actions to do something about it. We do have to put it in context, though. This starts on September 9th, the buyback, and then it sunsets the day after the election. So that's kind of a curious date there. So, we'll see how effective it is. We got a nice rally last Wednesday when he announced it, and then it just went away. So
Right.
when they
It's like
actually,
we see glimpses of it getting better on that side of things, and then we lose what we gained. And I mean, I have my monitor on my phone. I get those notifications. I'm like, "Yay, we're making it good. Today's a good day. We're in the green." And I think that's been hard for loan officers and consumers to navigate that, honestly. What's your advice to LOs or consumers out there that are like, I kind of say a bird in the hand. That the rates go up quickly and they come down slowly, kind of like your gas prices. So I think lock it, forget it. Is an eighth in rate going to rock your world higher or lower? If you're risky and you want to ride the wave, then somebody rides the wave, and can they pallet the extra that they're going to have, and it probably won't come down before a 30-day closing. But what's your advice to consumers and loan officers out there right now? Because it is a little bit unnerving, so to speak, on the daily.
yeah, absolutely. I'd say for LOs is find out, and that's what we try to provide here at PMR. We try to provide our LOs with, you know, a lot of the headlines. I get LOs coming to me with, "Hey, what does this headline mean?" And it's very misleading. They're often lagging. You'll see news outlets talk about rates going down, and they actually just spiked because they're like a week behind or a month behind. And the media does a really bad job of educating and talking about these issues, and they serve to confuse folks. I'm not ragging on the media. It's hard to do it, and we've become a soundbite clickbait kind of.
Well, there's a lot going on. So to have a 30-second little broadcast as they're coming out with the news, right? And look at all the things you've just talked about. So many nuances to what's going on.
Yeah,
So
so
in the
LLs need to
media,
find
yeah.
exactly. They need to find a good source that will explain it to them in a way that makes sense for the mortgage market. And because what you hear in the general media is a general consumer, a general story. It's not necessarily tailored to explain it and what that really goes. So for LOs, make sure you find a reliable source of information that's going to break it down in simplified terms, and it's going to make sure that it's responsive to the mortgage market and what you deal with on the ground. For borrowers, I mean, this is a very defensive market. I mean, I think, floating this market is dangerous. I mean, we've seen a lot of intraday volatility, but it hasn't been massive moves in volatility. It's been kind of, to your point, it's been an eighth or this or that. So, I mean, as it always comes down to for borrower, what is your threshold for, how much do you have to lose? What's your time frame? This is a purchase market. Let's face it, it's a purchase market. So it's probably more important to find an LO and a mortgage company that can close on time and get the deal done for you. So rate right now is kind of secondary. You're going to have to figure out how affordability fits into it, which products, which if it's a temporary buy down or whatever kind of trick you can use to to make the deal happen. Because right now, as we know, home prices are higher and rates are higher. It's tough to qualify borrowers. So I would say
I think that, you bring up the aspect of affordability, but on the flip side, gosh, I started to see rent go up in a lot of markets that had been lower. And so now it is almost more viable to buy a home in comparison to just renting. They say it's the highest it's been since blah, blah, blah. Well, the mortgage curve isn't necessarily following it as it usually would have, because I mean, at 4.7, you'd think we'd be seeing maybe rates in the sevens, and we're not really seeing that. So that it's been a little bit more milder in the change in rates. Granted, we're not seeing, any opportunity necessarily for crazy low rates or refinances in this market. But I think that we've kind of been blessed because at least we're in the sixes, we haven't seen it really spike in a when gosh, I mean, rates haven't changed that much between 4.2 and 4.7 on the 10-year. I don't know. And so I think that's a blessing and a silver lining in this market.
I'm so glad you brought that up. It's hard to, there's so many things now that are headwinds to the housing market, and so it's really good to take a perspective look at that, like you're doing, because really, in the scheme of things, I mean, the the last 10, 20 years have been an anomaly, really. I mean, with massive Fed intervention, suppressing rates way below where they normally would be. Rate is only one piece of the equation, right? And really, if historically 4.6, 4.3 on the 10-year today, I mean, that is not super high in the scheme of things. If you've just started in the mortgage industry 10 years ago, it might seem high, but it's not in the scheme of things and where the real price of money should be. So, and to your point, yeah, there are a lot of silver linings. I mean, as we mentioned earlier, I mean, mortgage spreads have tightened because there is less origination happening because of all those low rates. When the Fed, pushed all those rates, be careful what you wish for, right? Because it really kind of screwed up the housing market to get everybody into these 3%, 4% rates. It really put a kibosh on the housing market. It's trapped a lot of people, and it's led to much lower originations than we would normally have in a healthy market. So, but because of that, because there's less originations than there would be, mortgages are in demand and they're paying up for them. So we're seeing mortgage servicing rights, MSRs, which is a huge component of that goes into the pricing of a loan. Those are super strong. Investors are paying up for those borrowers or for the servicing rights of those. So the combination of MSRs strengthening and the combination of that with mortgage spreads tightening because they're in more demand, that has, relative to your point, to the Treasury, mortgages are in a better place than they were not that long ago. So we are benefiting from that, even if it doesn't feel like it.
Yeah,
Sometimes. So,
yeah. I think that the problem that most originators have seen is they get these glimpses that it's heading in the right direction and then it gets snapped away from them. So it's been this emotional yo-yo of just kind of the bounce. And my advice to loan officers, David sits on this side of the desk of helping us, provide the best rates and pricing he can to our team here at Premier. But I sit on the loan officer hat, and my job is to educate consumers. And then my advice to loan officers is to make sure that the borrower has the right to be part of the decision-making process. You holding the bag when market is volatile and then having to call someone and say rates went up a half a point since I quoted you initially is probably bad customer service. So making sure that the client is involved and it has a base understanding of why rates could move and the downside risk they have of waiting allows you to have higher level customer service, more opportunity for repeat business. All of those things, in my opinion, come from having the transparency around what's happening in the market. And honestly, Chat GPT has been, or chat or AI or whatever, Claude, whatever you're using out there. That's if you don't have a source of data like we do, and we're blessed to have that through David and his crew. But if you don't, it's a great opportunity to take whatever's happening in the market and say, can you give it to me on a level that a consumer that isn't doing a home loan can understand, so that they have and they have full understanding so they can make a educated decision for their family. And so you sit on the other side of like all this complexity that is living in that world. Thank God I don't have to think about all that every day. I can keep it pretty simple, but I think the yo-yo is pretty emotional for loan officers and has been hard to navigate for sure.
absolutely. And speaking of AI and just the context of our culture right now that we've just normalized and taken is this deluge of information, and from a lot of sources that may not be, um, completely accurate. So we're just awash in information, almost too much information. And so how do you how do you take, what do you know? What do you point to? What do you listen to? Because there's just so much. And a lot of folks have just tuned out because it's too much. And so finding that source of information that you can reliably trust and that you can and that is tailored to what you need to know for your borrowers is critical. And the AI piece, incredibly helpful and powerful. You got to be careful though, because it's in its infancy and it still can be wrong. So it's always good to have something to check it up with. But the AI story in general is a huge piece of the prior discussion we were just having about demand for our debt. There has just been a massive spend, capital expansion for AI, for building the whole thing out. And this is, we, to some degree, I don't,
You feel like it's a benefit to America as a whole on the AI side, or you don't?
well, it's in competition because there's an incredible amount of private debt that's being issued to fund all of this capital expansion to build out the AI networks. And that's in competition with our treasuries. So it's, you know, is it a good thing? Well, is it a good thing in the end if we can win the I race and it becomes the thing that really helps us get forward? Yes. But in the interim, it's another headwind for our treasury market. So right.
You're saying there's only so many investors in the market, that there's only so much liquidity or cash to invest, and it's taking away those funds and moving them to AI when they could have been buying Treasury.
I mean, Alphabet, Meta or Alphabet, Google, one of the biggest players in this space. I mean, they're having to pay 6-7% on some of their debt that they're taking out. And so investors are like, well, hey, and they're not gonna default on debt. I mean, I would count on Alphabet just like I would the US government. So why don't I get 7% instead of 4.6 or 5.1 on the 30-year? So that's the whole credit market there with, chasing yield. When rates are suppressed by the Fed in the previous cycle, there's a lot of risk being taken because investors will want more yield. It's just that simple. You want more money you're investing money, you want a better return on it. And so if you can get a better return from a company that you are convinced is solid, that puts a strain on the demand for treasuries. And it's not just the other central banks. It's not just all the big investment bond companies or the trust fund, all the big institutional funds that buy our debt and buy mortgages. It's not just that story. It's also the story of AI and the demand that they're getting for the debt that's funding all that capital expenditure. We've never seen anything like this outside of world wars, right? This kind of spend, and we just hear about it. We think, oh, AI is going to take over. It's robots. It's this. What is it? And now the political conversations are so much focused on data centers. And that's really, I mean, I'm not going to say somebody shouldn't be concerned about data centers, but that's such a small piece of this pie when you think about because if they're getting it wrong, I mean, this is such an amazing amount of money that's being spent. Um, if they get it wrong, it's a lot of money in the wrong direction. So it's something to be paying attention to. Data centers are only a small piece of that. They are critical because it's all about computing, right? Think about all of us entering all these things all day long in AI. Well, there's got to be a data center somewhere that can handle all that compute. And so we're going to have to build those out significantly. And of course, it has a direct impact on commodity prices, which feeds into our whole discussion about inflation. And we haven't even gotten to that yet. But AI is creating such a high demand. So it's not only challenging the treasury market in terms of demand, but it's pushing up commodity prices and incomes, because you need folks to build this stuff out. You need all the materials that go into building this out, whether it's chips, copper, plumbing products, whatever it is. It's a huge demand, which is fueling inflation. And we know inflation is one of the worst things for bond investors, right? Because if you invest in a bond and it's worth, inflation goes up, it erodes the value of your return. So inflation is part of the reason why a lot of folks are thinking the Fed actually is going to have to raise rates to to address. We've had 6 years of above target inflation. We've got the PCE coming out tomorrow. That's the Fed's preferred inflation indicator, and it's going to be probably higher. And so we've got a new Fed chair, Warsh, who has gone, who wants to change the the way the Fed communicates, but he also wants to change a very fundamental thing, which is we've gone through basically a generation of the Fed in high intervention mode, of really supporting the market, of almost kind of controlling the market in a way, either because we came out of the great financial crisis or we have COVID. So these two huge shocks to the economy, and we responded by pushing rates down. And folks who are critical of that would say, well, you're artificially suppressing rates, and it's putting off the things we're going to have to deal with, which is long-term demand for our debt. And we just what found out our debt now just is $40 trillion. So the bond investors are saying, hey, you've got to deal with this. You've got to deal with the amount of debt you have, because it's going to lead to a debt crisis. And if we're going to take out more debt, we're going to charge you more. And that's the term premium, if you heard that. Not to get too wonky here, but term premium is really, it's just simply the added costs that bond investors are asking to take out 10-year, 30-year debt, right? Because they're concerned about the future. And the fact what we're dealing with now, we've got the Jackson Hole speech. It's a big deal for the Fed and the Fed chair. Jackson, all the investors look at this. Happens in Jackson Hole,
They're
right?
waiting to hear what's gonna happen too, just like we are, right?
That's right. And it's really interesting now with what Besant just did, because he's kind of taken the ball into his own court, so to speak, and saying, okay, he's obviously probably being
You do
direct.
you, boo, I'm gonna do me, and we're gonna see how this all shakes out. If you're not gonna handle it the way we think that you should, we'll just take matters into our own hands and start handling that, right?
Yeah. And it's interesting because Kevin Warsh he was a Fed governor when we were coming out of, we're in the financial crisis, and the Fed did that massive intervention and all that. Now, he was critical of some things. He's been an independent thinker, but he was there and he went along with it and helped deliver that policy. He's really saying now we've got to step back from all that. We've got to let the private market set rates, do its thing, price discovery. That's what markets are for. And the Fed needs to take a back seat, and the Fed doesn't need to tip the hand. It doesn't need to forward guidance and, lead the witness, so to speak. So
Well,
we'll see
I
if he's,
believe that in a way, but history has proven a couple things. One is the housing market in America drives a lot of industry, a lot of industry. AI is driving a lot of industry right now. So does the housing market. I mean, and somebody turns 18 every day, and the housing market in America is so critical to all kinds of economics throughout the US. That's always gives me a silver lining, or an underlying confidence that mortgages in America, homes in America, are very critical to overall success. And from the loan officer side of things, my belief has been, Fannie and Freddie, they're in business. They have the beats to feed too. And what we found is when rates typically go up or there's less mortgage origination, we see opportunity through new loan programs that they roll out or new opportunities they give, because they need to be able to. And I'm not talking about risky mortgage, and I'm not talking about BC World, and I'm not talking about all those crazy things. I'm just talking about Fannie Mae and Freddie Mac offering more loan programs that offer more opportunity for buyers to get into the market. I think the LLPAs get kind of questioned at times where rates are going up. They seem, the loan level price adjustments seem too crazy on conventional loans. So to me, those two factors have always had an underlying play in all of this, economic talk. That gives me hope for the future, right? That's why I think that this is so talked about. That's why if the feds aren't going to take care of it, I think the Treasury comes in and says and participates, because they know that housing is so critical in America.
it absolutely is. And really what whether it's the housing market and the challenges with new production, right? We know there's regulations, zoning, all the things that are a barrier to getting more production, whether it's the cost of land, whether it's the risk to the builder, all of those things, these are political problems because we have, and it's and the issue with what the bond market is saying is, get your economic house in order. The good news is, to your point, the reason to be hopeful is these are just political problems. They're not. We have plenty of money. I mean, look at what we're spending on AI. Look at what we spend at Starbucks every day. I mean, we have plenty of money. We just have to have the political courage to make the tough calls, whether it's entitlements, the budget, how much we spend on the military, on entitlements, taxes. We don't like taxes, but you know, the top half of the top half of the country has, a much lower effective tax rate than historical norms, and they've greatly benefited from all of this innovation. So there's a whole lot of money out there. It's just, what politician is going to say we need to, raise taxes and cut programs? No one wants to do that, and we've been kicking the can down the road. And you can put the Fed's behavior in context with that, because our government has not made the tough calls to do the right
For
thing.
many, many, many years, administration, we're not talking about politics here. We're just a government in
Our
general.
government, our whole government, not an administration. Yeah, our whole government for a long time has not made the tough choices because it's hard to tell a voter, I need to make a tough choice. But you can see that in the context of that. What I'm bringing that up is because it explains why the Fed was doing what it's doing, because the government wasn't taking care of business. The Fed had to come in, and they only have so many tools in their toolbox, and one of the main ones is rates, right? So we've been kicking the can down the road for a long time, and eventually we're going to have to deal with it. And that sounds like a negative, but actually the positive is we have all kinds of resources to deal with it. We just have to have the political will as a country to do it, and we will. I think it's going to happen, but it may take some shocks. Unfortunately, it may take a bond crisis. It may take another hit. We don't want to see that, but it's
Well, I
certainly.
just again, I'm going to go off what I know to be true today, and that is that housing in America is critical to our, economic success. And as a result of that, I think that they're going to continue to push on it. Understanding on your daily makes you a better loan officer, and you don't have to understand it in depth. I have not nearly the knowledge of David Dysert when it comes to the markets, but I know enough to help guide my clients. And at the end of the day, loan officers, that's what you need to be able to do, is just guide your clients to the success so they can get into a home that they can afford a payment, that can reach their goals of home ownership, and not get so deep in the weeds, because most times if you get too deep in the weeds with your consumers on all of these topics, it gets pretty blurry pretty quick. I mean, gosh, we're here navigating this, and it's blurry for our federal government. It's blurry for the Treasury. It's blurry for people that do this every day. So my advice is to keep it very simple. So optimistically, I know your crystal ball has not arrived from Amazon. Mine is still on back order. I just don't know where it's at. But what do in the future, what are you kind of seeing coming the rest of 26 or moving into 27? Any silver linings or big concerns outside of just getting our debt in order, which could be a long-term thing?
Oh yeah, that's not a short term. That's a long term challenge. The rest of the year, I mean, we were certainly expecting a better year this year in terms of origination and the housing market. I mean, it's been relatively resilient this year, given all the headwinds. I mean, whether it's the war in Iran, the supply shock, energy, inflation, all the bond market stuff we're talking about. That's a lot of headwinds. And I think the really great story there is the housing market has held up pretty resiliently. I think the second half of the year is going to get a little choppier. It's going to get a little harder, probably. I think there is some exhaustion out there. I think, war really does have an effect on people's psychology. I'm curious what you see on the ground there. But we are starting to see a little erosion in volume, and that means you're going to have to get scrappier and figure out, what are those products and what are those markets that are going to help sustain volume for you.
Well, I think that on the outside of things, we bring up the AI piece and we bring up so much job opportunity there. But I've also seen, customers be concerned about jobs, and that might be a reason that they aren't necessarily buying right now, is because they're concerned about their strength of their job. And again, it's like a double-edged sword in that nature, right? On this flip side, we need the jobs to help people close home loans, but if we have greater unemployment, the rates go down. So it's like on one side, do you need it, and the other side, you want it. So we're
So it's
still
finding that Goldilocks, right? It's the perfect porridge temperature so that you've got employment, 'cause people can't buy homes without jobs. But not having the economy going so gangbusters that inflation is running up and rates have to go higher. So there's that.
well, is there a
We're
new
looking.
do you think that there's a new basis for GDP? I mean, that we've always lived on this, like, what is it, 2 points I mean, again, your world, not mine, but we've always lived at this point where this is the goal for GDP, and now with everything going on, maybe there's a new basis? I don't even know how that basis initially came to be. Will you speak to that? It kind of on that topic because I think that in a way that plays also into the Fed's decision and inflation markers and all those things. I think that, is there
Well, you want growth.
new normal?
You want growth to, account for inflation and to be more than inflation. So that's really growth, right? So you want the economy to be able to absorb a reasonable amount of inflation if needed and go above that. So the current situation, again, I can't stress enough how bizarre and huge this AI capital spend is. It's mind-boggling the amount of
Wild,
money.
right?
It's wild, and that is really influencing everything right now. So I don't think we're gonna retool how we look at everything in the middle of this right necessarily. The Fed is definitely in a process right now of looking at, and I think it's a good thing to look at, okay, what are the metrics that we traditionally have used? I mean, think about what we were doing 20 years ago. Think about the economy, what you were doing 20 years ago, what your neighbors were doing, how people were making a living, where they were working, all of these things. It's dramatic changes for a lot of the country from 20 years ago. And we're still using the same way of collecting information and analyzing and the same metrics. So it is it's a good opportunity now to really look at that. I mean, the gig economy, that didn't exist 20 years ago. What does full employment look like in a gig economy? What are the barometers, what are the metrics that we're using? Because if you look at our normal metrics, the economy looks like it's booming, and it is for some people, but there's a whole lot of folks in America where it's not. And so,
Right.
it's becoming more complex, and I think we
So we're
have to
using
really
our
look at.
old philosophy in a new world, and we're using those old metrics and get like you say, gathering data. I mean, I think they look at, Barry Habib said they look at data that's 6 months old for rent. 6 months ago, what were you paying in rent? And they're strictly going out to humans and saying, "Hey, at this apartment complex in New York City, you're paying this much money. Cool, that's the number." And now data is so much more readily available. So to your point, how they collect that data is archaic in comparison to the future and the speed at which we get information. So I mean, anybody talking about that, fixing that, or they're just gonna keep on doing the old school stuff?
Oh, sure, and I mean, there's a lot of work being done on new economic models, and Chair Warsh has made that a kind of a key piece of his first term here. He's formed a bunch of um, groups to kind of analyze different pieces of this and come up with some suggestions on, how should we be measuring things and looking at data differently. And it's always good to review. Maybe they don't change a lot, but to review it, given what's happened to the economy and how we're operating, I mean, it's a good thing. So we'll see what comes out of that. What the market is concerned about, just to wrap this up on the Fed, also in the Treasury as well, with Besant's recent announcement on that buyback that we talked about earlier. The bond market is losing a little bit of confidence, or certainly has a question mark on Warsh and now Besant, because what the bond market really wants is they want to see that they have a resolve to deal with inflation. Again, inflation is your number one enemy if you're a bond investor. And so the bond market is saying very loud and clear to Warsh and now Besant, don't want any gimmicks. We don't want you being influenced by politicians. We want you to stay true to your mission, and we want you to get serious about inflation and get this in check. And, And so that's really what's going on right now is there's a lot of question marks. Not only is the communication style of the Fed now changing, but the market had become dependent on this constant stream of forward guidance, but they're concerned that there's political influence, or there may be, just a lack of conviction of holding true to that 2% inflation mark. So
Inflation.
Porsche said some good things
That's
about
what
it.
I'm saying. Is that an archaic number? Is two an archaic number in the inflation markers? Is that we're using this old data, and this 2%, is that normal when you've got all these other factors? I'm like, I kind of question that.
Well, that's certainly Besant and Warsh's narrative. That's to your point there. They think that AI is going to achieve this revolution in productivity, which is going to offset some of these pressures, like inflation and things like that. That's a TBD. We don't know. What the bond market does know is that they don't want inflation to stay high, and they don't want it to get worse. And there's a ton of pressures going on around the world that are contributing to higher inflation. So, yeah, until if the Fed wants to, there was talk before Warsh even came in about, is the new normal, should it be 3%? Is that really, it says 2%, that's their mission, but are we really going to allow it to be in the more 2 to 3% range? That's an ongoing question. Warsh has been very emphatic. He said it's 2% period, full stop. So he said the right things, but the market still has a TBD, a question mark on him. So that's that push and pull, and that's
And
what
so
we're
this
be
week,
watching for.
when do we hear from the feds again? And this week is big because of
The Jackson Hole
Jackson.
Symposium, which has already started, but they will. The big deal is the chair speech on Friday. So we'll hear from Chair Warsh on Friday. All eyes and ears are going to be on him on that, and the market's really going to see if they can get anything out of him, because
Glean anything from what he's saying about what the future looks like from the Fed's
that's right.
standpoint.
That's right. So we'll look at that, and then the Fed's next rate setting meeting, FOMC meeting, is September 17th, 18th. So that 70% chance they're going to hold, but the market is thinking they're going to raise maybe in December or in between there sometime. So pretty much guaranteed they're going to hold unless we get some sort of something in the next few weeks that really changes. We do have the PC inflation tomorrow. We'll hope the Fed comes in tame. That will be good for us. But the market's going to be paying attention to anything that has anything to do with inflation between now and the Fed to see. But they're pretty much assuming that they're going to hold because we've had some weaker job numbers come out.
Yeah.
So the economy seems to be, we're not veering off a cliff, but there does seem to be some softness, some softening. So we'll see that. I mean, any softening will help keep them from raising rates, but we're going to hope that inflation number comes in lower. So yeah.
Pay attention to your numbers. Pay attention to, I heard, pay attention to PCE, what Mr. Warsh has to say, and inflation numbers. Yes. And employment numbers. All of those are factoring. There isn't like one thing that's factoring anymore. You used to be looking for your employment numbers, and that was the thing. You used to look for inflation numbers, and that was the thing. It seems like they're all a thing. Everything is playing right now because there's so much uncertainty. And based on what you're saying, that's why all of those are playing, is because of the uncertainty that those leaders of our country have today.
Uncertainty is a huge headwind for our market, and for the bond market. Absolutely critical piece there. Inflation and uncertainty are the two main drivers that would push rates higher above the normal shock type things like supply shock and energy prices from geopolitical situations. So I think what we're seeing, just on that inflation side, real quick, the economic D-Day that was announced yesterday by Besant to try to force Iran's hand by getting at them a really severe set of sanctions and chokeholds on their economy. The challenge with that, just to point out that, China and Russia and India, we can't force them to not trade with Iran. So we'll see how effective that is. But if anything, if it's effective, which is why we're getting a nice screen on the screen today, rates are a little better today. Oil's come down because there is hope and optimism that the talks are restarted and there's some progress there. So really, if nothing else, if that that announcement of those sanctions, if it promotes a dialogue and gets us to a resolution sooner, that's a win. So that's really what we need to see. We need to see this Iran situation resolve, the strait opened up, the full, free flowing of goods and oil, and that's going to be very helpful for us. So anything that'll get us closer to that is a good thing. So let's hope for.
Well,
Let's
I
hope.
always appreciate you so much for giving all the guidance for our loan officers and the snippets we get to put on social media that give consumers or LOs the guidance that they need and having a voice like yours that provides truth and knowledge behind it, not just a 30-second clip on national media news. I'd say turn off your news, friends. That is not where to go. Consumers, turn off your news because not that I don't love our news anchors here in my hometown, I do, but they are the source of knowledge. And so I think what David's message is find a source that you can trust that provides you the knowledge you need while making decisions about either your LO business or a consumer wanting to lock an interest rate, right?
Absolutely.
Well, thank you for being here today. It's always fun and I always appreciate you so much. So thanks for being on Origination Boost.
Awesome. Great to be with you. Take care.